If you're trying to get a mortgage in 2014, you may find it's harder. The reason is that new rules go in effect in January. The need for almost perfect credit is one reason the housing market is only slowly recovering from its recessionary bust. But now, as Diana Olick reports, lenders will be asking for even more information.
During the last housing boom, lending standards went out the window, and we all know how that turned out. So Congress passed a law requiring lenders to make sure borrowers could pay their loans. They directed the Consumer Financial Protection Bureau to create rules to help ensure that. The rules are not mandatory, but if a lender follows them, they have made a so-called qualified mortgage and get legal protections should the loan go bad.
The biggest change for the average borrower is going to be just increased documentation.
But borrowers will also be limited by the new rules, which ban riskier products like interest-only loans. The lender must verify income and assets and not charge excessive fees, and the borrower cannot spend more than 43% of their income on debt. That last one will knock a lot of borrowers out, especially those who might actually be quite wealthy outside of their income. That's where some lenders will choose to operate outside the new rules.
Looks like a nice niche from a lender's perspective because you're not going to have as much competition. Certainly you're going to have a much more regulatory risk.
That's why those who are choosing to operate outside QM, like Wells Fargo and Bank of the West, say they will only do so for the very best candidates.
We're going to apply a very strict table of qualifications to ensure that there's additional income as well as additional assets to be able to support the case that these borrowers did in fact have the ability to repay when we made them the loan.
In other words, wealthy borrowers who just happen to be driving the housing market right now because lending is so tight. The average loan size today is at an all-time high, almost $270,000, because less affluent, less credit-worthy borrowers can't get a loan, or at least a loan they can afford.
The buyers that are out there are much more affluent. They have much larger home savings and home equity saved up, and they're looking for a larger type of house. And the first-time buyer, unfortunately, remains pretty well locked out of the market.
The rules won't make it any easier for first-time buyers to get a loan, but as the rules settle in and lenders get more comfortable operating outside of them, that may change. Some lenders may be willing to take on those borrowers and the risk that goes along with them. Of course, they'll charge a hefty fee to do it. For Nightly Business Report, I'm Diana Olick in Washington.